$84. That is what physical silver buyers in Shanghai paid this week. The price on your screen, the one every Western financial channel is quoting, says $78. Same metal, same ounce. 12% more in the market where delivery is actually required. That gap does not exist by accident, and it does not stay open forever. Tonight I want to show you exactly what it means, and why the $78 COMEX price may be the most misleading number in precious metals right now. Last week I told you to watch the Federal Reserve dot plot, specifically whether the median dot for 2026 showed 1 cut, 2 cuts, or 0 cuts. I said the dot plot drops at 2 p.m. Eastern on Fed Day, and you do not need anyone to interpret it. Just count the dots for 2026 and see where the median lands. Here is what happened. The Fed held rates at 3.5 to 3.75% as expected. The dot plot showed a cautious posture, limited appetite for cuts in the near term. Powell's language acknowledged stagflation risk from oil but did not deliver the dovish pivot the bulls were hoping for. Gold tested the 5,000 level and held with some volatility. That call gave you the framework to watch the right thing in real time. Now this week the story has moved. Gold is still near 5,000, but silver is where the structural signal is flashing, and that is what this entire video is about. My name is John. 15 years in currency and commodity markets before I ever picked up a camera. I left that world because I believed the people watching their savings from home deserved the same level of analysis the institutions were getting. That is what we do here at Currency Insider. Everything I show you today comes from publicly available sources, and I will name everyone as we go. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, do it now, because what we are covering today is part of a bigger picture we are building week by week. 3 things today: what the Shanghai COMEX premium gap actually is and why it matters, what the physical delivery mechanics mean for the COMEX price over the next 60 days, and what the gold-silver ratio at 62-1 is telling serious investors right now. So here is where we stand this week. COMEX silver is trading at approximately $77 to $79 per ounce. That is the number most Western investors are looking at. The Shanghai Gold Exchange is pricing physical silver at between $84 and $93 per ounce. Dubai is at $91. The spread between Shanghai and New York is somewhere between $6 and $20 per ounce, depending on the contract and the day. Shipping costs between these markets, genuine, verifiable logistics costs, are approximately $1 to $2 per ounce. So the arbitrage should close itself naturally if this were simply a transportation or currency issue. It has not closed. It has been widening. The gold-silver ratio sits at approximately 62-1 right now, meaning 1 ounce of gold buys 62 ounces of silver. And the DXY, the US dollar index, is holding around 99.50, just below that structurally significant 100 level we covered last week. That is the picture. Now let me show you why each piece of it matters. Let me start with the most important structural point in this entire video, because this is the thing that separates what is actually happening from what the headline price suggests. There are 2 kinds of silver markets operating simultaneously right now. The first is the COMEX market in New York. This is a futures market. It is a paper market. Fewer than 1% of COMEX silver contracts ever result in actual metal changing hands. The price discovery on COMEX is driven primarily by financial participants, hedge funds, algorithmic traders, macro funds, who have no intention of ever taking delivery of a single silver bar. They are trading a financial instrument that happens to be denominated in silver. The second market is the Shanghai Gold Exchange, the SGE, and specifically the contract called AG-T plus D. This contract requires physical delivery. When you buy it, you are buying real silver that actually moves from a vault to a buyer. The SGE is the world's largest physical precious metals exchange by volume. When the market that requires delivery prices silver meaningfully higher than the market that does not require delivery, that is not noise, that is signal. Think of it like 2 petrol stations on the same street. One has actual petrol in the tanks right now. The other is taking orders and promising to source the petrol later. Normally they charge about the same price. But if actual physical petrol is getting scarce, if the tanker deliveries are being delayed, the station with real petrol in the tank starts charging more. That is what you are watching in silver right now. Shanghai is the station with petrol in the tank. New York is taking orders for future delivery, and the gap between them has been telling you something for months. The most recent data from the Shanghai Gold Exchange, flagged by Silver Trade and SD Bullion in their published market reports, shows that on December 24, 2025, the physical premium on the SGE exploded to over $8 per ounce above COMEX futures prices. Silver went into backwardation in China even with $7 premiums already baked in. Backwardation, for those who want a plain English translation, means the market is paying more for metal right now than for metal delivered in the future. That is the opposite of the normal condition. It only happens when immediate physical availability becomes acutely stressed. That stress event in December has not structurally resolved. The conditions that caused it are still fully in place. So what is driving the physical tightness in Shanghai specifically? 3 documented forces: solar panel manufacturing demand, EV battery production, and import quotas. Let me take each one briefly. Solar silver demand is not a projection. It is a current reality. The Silver Institute has been tracking silver consumption per unit of solar capacity deployed, and the numbers have not reversed. China is the world's largest solar manufacturer by volume. The silver content inside each panel is small, but when you are manufacturing at Chinese industrial scale, small per unit becomes enormous in aggregate. EV batteries are a secondary demand driver, not as large as solar but additive. And then the import quotas. This is the piece that gets underreported. China periodically manages silver import flows through quota systems. When quotas tighten, the domestic Shanghai market becomes partially decoupled from international supply. Metal that would normally flow in to close the arbitrage gap cannot move freely. The result is exactly what you are seeing: a sustained premium that shipping arbitrage alone cannot close because the flow is restricted at the border. Now here is the part of this story that matters for Western investors. And this is where I want to be very precise because this is where a lot of channels get loose with the analysis. There is a physical flow happening right now that the SD bullion data flagged specifically. 1,000-ounce silver bars, the large format bars held in Western vaults, including COMEX and LBMA, are being pulled from Western storage and redirected toward Eastern demand. This is not a rumor. It is visible in the withdrawal data. COMEX registered inventory, the silver formerly available for delivery against futures contracts, has been declining. The figure I want you to look up and verify yourself before you take this as gospel is the current CME warehouse report. When I pulled the most recent available data, registered inventory was in the region of 27 million ounces. That number matters because it represents the buffer between paper contracts and physical delivery. If that buffer keeps shrinking while open interest on the paper side stays elevated, the tension between the paper price and physical reality increases. If you know someone who holds silver and has been trying to make sense of why the price on their screen looks so disconnected from what they are reading about physical demand, share this video with them right now. This breakdown is exactly what they need, and they are probably not finding it through a search. Now let me bring in the COMEX delivery mechanics, because this is where the 60 to 90-day picture gets genuinely interesting, and where I want to be careful not to overstate what the data supports. COMEX futures contracts have delivery months. As a delivery month approaches, open interest in that contract either rolls forward, meaning the holder closes their position and opens a new one further out, or it moves toward delivery. The overwhelming majority of participants roll, but the key variable is registered inventory. If the holders of open interest in an approaching delivery month decide to stand for delivery, to actually take the metal, they can only receive what is in registered inventory. If registered inventory is 27 million ounces and open interest representing significantly more than that demands delivery simultaneously, you have the setup for a delivery squeeze. I am not telling you that squeeze is happening. I am telling you the structural conditions that would enable it are more present today than they have been for a long time. The May 2026 delivery window is the one to watch. That is the next major delivery month. If Shanghai premiums remain above $5 per ounce through April, meaning the physical tightness has not resolved, the incentive for large holders to stand for delivery on COMEX rather than roll increases, and that changes the pricing dynamic in the paper market. Here is an analogy that I think makes this visual. Imagine a hotel that has sold more rooms than it actually has, counting on the fact that most bookings get canceled or changed. That has worked fine for years. But suddenly cancellation rates drop. Suddenly most of the people who booked actually show up. Now the hotel has a problem. It has to find real rooms for real guests. The cost of solving that problem is not small. COMEX is that hotel. The registered inventory is the actual rooms, and the guests showing up are the holders demanding physical delivery. The question is, how many guests arrive in May? All right, let me show you how I am thinking about all of this using the 3 lanes framework, because this is the tool I use every week to separate noise from signal, and it is the most useful thing I can give you for navigating a week like this one. Lane 1, the paper market, blue. CFTC commitment of traders. Data shows managed money positioning in silver. I want you to note something important here. When hedge fund net longs are low, when the professional paper traders are underweight silver, that is historically, when the physical paper divergence matters most, because there is less speculative froth in the paper price to unwind. The paper price in that environment more closely reflects genuine supply-demand fundamentals. I pulled the most recent CFTC Co-T report, and managed money positioning in silver has been cleaning up, moving toward a less crowded long position. That is a constructive setup for the next move, not a warning sign. Lane 2, the physical market, silver. SGE premium $8 to $15 above COMEX. COMEX registered inventory declining. 1,000-ounce bar withdrawals from Western vaults documented. That is 3 independent physical signals pointing in the same direction in the same week. Lane 3, macro, gold. DXY below 100. 10-year yields around 4.2%. Gold-silver ratio at 62 to 1. That ratio number is worth dwelling on for a moment. In past cycles, 1979 to 1980, 2009 to 2011, when the gold-silver ratio compressed from elevated levels, silver outperformed gold by multiples. Not percentage points, multiples. In 15 years watching currency and commodity markets, the times I have seen all 3 lanes align in the same direction, physical tightness, paper market cleanup, and macro tailwind simultaneously. Those have historically been some of the most significant setups in these markets. I am not saying we are fully aligned today. I am saying 2 of the 3 lanes are clearly pointing in the same direction, and the third, macro, is in a supportive configuration. That is a framework for understanding what you are looking at, not a forecast. You decide what to do with it. Here's the one thing I am personally watching this week. One thing. The Shanghai COMEX silver spread, specifically whether it holds above $5 per ounce through the end of this week and into next. The SGE publishes its AG-T plus D price daily. COMEX publishes its settlement price daily. The spread is public information you can track yourself every single morning. Here is why this specific number matters for the next move. If the spread narrows below $2, the physical tightness signal weakens, and the bull case for near-term COMEX convergence loses its primary evidence. If the spread holds above $5 or widens further, the structural case strengthens, and the May delivery window becomes a genuine event risk for the paper market. This is my one call for the week. John, FX Insider. On record. I will be back next video to tell you exactly where that spread landed. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is the moment where channels either get honest or get promotional. I'm going to give you both sides of this with genuine equal weight. Here is what needs to happen for the optimistic picture to develop. The Shanghai COMEX spread remains above $5 through April. COMEX registered inventory continues its decline. As May 2026 delivery approaches, open interest holders in meaningful numbers choose delivery over roll. COMEX pricing is forced to converge upward toward SGE pricing, rather than SGE pricing correcting downward. Silver moves from 78 toward 85 and beyond on a fundamental basis, rather than speculative momentum. That is the bull case, and the structural evidence for it is real and documented. Now here is what needs to happen for the cautious picture instead. Industrial demand in China slows, factory output drops, solar build slows, EV production softens. The SGE premium collapses below $2 as Chinese domestic demand weakens. Western import restrictions ease, allowing physical flows to normalize. COMEX silver falls through $75 support, and the gold-silver ratio widens back above 65. That bear case is also entirely possible. China's industrial cycle is not immune to slowdown. The premium could reflect temporary quota effects rather than structural scarcity. Paper markets can suppress price for far longer than fundamentals justify. Any silver holder from the 2012 to 2020 period knows this from painful experience. Both scenarios are genuinely live right now. For UK investors holding silver in a SIPP, the LBMA price is your benchmark. And the LBMA is directly connected to the physical bar flows we have been discussing. The 1,000-ounce bars being pulled from Western vaults toward Eastern demand move through London. That is not abstract. That is your market. Both outcomes are possible. Your job is to watch which conditions are actually developing. The SGE spread is your real-time signal. Check it every morning. The market will tell you which scenario is unfolding before any analyst does. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this breakdown today, the like button takes 1 second, and it genuinely helps this channel reach the people who are trying to navigate these markets without the noise. Hit it now. I want to ask you two things, and I genuinely want your answers. First, are you seeing elevated premiums at your local dealer right now compared to 3 months ago? Or has your retail experience stayed flat relative to spot? That comment section becomes a real-time ground-level data point, and I read every single one. Second, the SGE COMEX spread is sitting between $6 and $20 right now. What is your read? Does that gap close upward, meaning COMEX rises to meet Shanghai, or downward, meaning Shanghai corrects back toward New York? Drop both answers below. Subscribe because next week we are going into exactly how to read COMEX registered inventory, the specific numbers to watch, what the withdrawal rate means for delivery month risk, and how to build that into a framework for your own positioning decisions. That is a practical skill, and it is worth having. And if someone in your life is holding silver right now and wondering why the price on their screen looks so disconnected from everything they are reading, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.